The Nasdaq 100 has been one of the top-performing ETFs of the past few decades. It's the crown jewel in many investors' portfolios, packed with tech giants like Apple, Microsoft, Amazon, and Nvidia. If you've been investing over the past 10 or 15 years, chances are you've looked at the Nasdaq 100 and thought, wow, this thing just keeps going up. And it's true. When the market's hot, the Nasdaq 100 tends to outperform the broader market. It's like rocket fuel for your portfolio during bull runs. But here's the catch. And it's a big one. While this ETF shines when times are good, it could also be one of the riskiest ETFs you can buy. And when things go bad, when we hit the next major crash, you could end up waiting much longer to recover compared to someone holding a broader ETF like the S&P 500. And I don't mean weeks or months, I'm talking years, even over a decade in some cases. In this video, I'm going to break down exactly why that happens, and I'll show you historical examples that highlight the risks hidden behind those impressive long-term returns. So, stick around, because this might change how you think about risk in your portfolio. And by the way, if you're new here, welcome to the channel. We're all about smart investing, managing risk, and building wealth over the long term. So, if that sounds like something that interests you, don't forget to hit that subscribe button and turn on the notifications. All right, let's jump in. First, let's make sure we're on the same page about what the Nasdaq 100 actually is. The Nasdaq 100 is an index of the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. It's heavy on technology and growth stocks, companies that are often seen as innovative, disruptive, and future-focused. Think about it. Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla. These are the kinds of companies that dominate headlines and drive excitement in the market. And because of that, the Nasdaq 100 has absolutely crushed the broader market during certain periods. Over the last decade, especially in the low-interest rate environment after 2008, the Nasdaq 100 outperformed the S&P 500 by a wide margin. But here's where people get lulled into a false sense of security. The Nasdaq 100 is extremely concentrated in a handful of sectors. Over 60% of its weighting is in technology and communication services alone. And that lack of diversification can become a real problem when the economic winds change. Let's be honest. The past 10 to 15 years have been fantastic for tech. We've lived through a period of cheap money, easy access to capital, and massive adoption of technology in every part of our lives. But the tide is shifting. Interest rates are now at levels we haven't seen in well over a decade. Inflation, although cooling, is still stubborn, and economic uncertainty is rising. In this kind of environment, the Nasdaq 100 becomes a lot more vulnerable. Why? Because tech and growth stocks are extremely sensitive to rising interest rates. Here's a simple way to think about it. Tech companies tend to be valued based on future earnings, cash flows that are expected 5, 10, even 20 years from now. But when interest rates rise, those future earnings are discounted more heavily, making them less valuable in today's dollars. That's why tech stocks often fall harder when rates go up. Now compare that to sectors like utilities, healthcare, or consumer staples. Businesses that tend to be more stable and continue generating solid earnings no matter what's happening in the economy. The Nasdaq 100 doesn't have much exposure to those sectors, which means when tech gets hammered, there's not much inside the ETF to cushion the blow. Let's go back and look at history to see what this looks like in practice. The dot-com bubble of the late 1990s is probably the most famous example. During that period, tech stocks were the darlings of Wall Street. The Nasdaq 100 skyrocketed as investors piled into anything and everything related to the internet. Some of the companies didn't even have real business models, but it didn't matter. Hype was king. But when the bubble burst in 2000, the Nasdaq 100 dropped by nearly 80%. That's not just a correction, that's a full-on collapse. And here's the part people often overlook. It took around 15 years for the Nasdaq 100 to recover to its previous all-time high. Imagine buying at the top in 2000 and having to wait until 2015 just to break even. In contrast, the S&P 500 dropped around 50% during the same crash. Still brutal, but not as devastating. And it recovered by 2007, well before the Nasdaq 100. Let's pause there for a second. Most investors talk about how important it is to stay invested for the long term. And that's true. But if you're stuck in an ETF that takes 15 years to recover, that's a long time to be sitting underwater while the broader market recovers faster. Now let's fast forward to the 2008 financial crisis. The S&P 500 dropped about 38%, and the Nasdaq 100 dropped about 42%. The gap wasn't huge on the way down, but again, the recovery timeline tells the real story. The S&P 500 made a full recovery by early 2013. The Nasdaq 100 lagged behind, taking a bit longer to catch up. And there's another important point here. During the recovery from 2008, sectors like financials and consumer staples, which have stronger representation in the S&P 500, bounced back earlier and steadied portfolios. Meanwhile, the Nasdaq 100 was still leaning heavily on tech, which took time to regain its footing. Then we have the crash in 2020 following the global health crisis. This one was a bit of an outlier. Both the Nasdaq 100 and the S&P 500 fell sharply. The Nasdaq dropped around 30%, while the S&P fell about 34%. But here's where it gets interesting. The Nasdaq 100 actually recovered faster this time. Why? Because the pandemic supercharged the adoption of technology. Remote work, e-commerce, cloud computing. All these trends exploded, and tech companies were in the right place at the right time. But does that mean the Nasdaq is safer now? Not exactly. That recovery was fueled by unique circumstances and historically low interest rates, which have since reversed. In 2025 and beyond, we're potentially looking at a much less forgiving environment for growth stocks. So let's zoom out. When you look at the big picture, what you'll notice is that in times of crisis, concentrated indexes like the Nasdaq 100 tend to suffer deeper drawdowns and longer recovery periods compared to broader, more diversified funds. That doesn't mean the Nasdaq 100 is bad. It just means you need to understand what you're buying. If you're young, have a long time horizon, and can stomach the volatility, having some exposure to the Nasdaq 100 might make sense. It could supercharge your returns during a bull market. But if you're nearing retirement, or you simply want a smoother ride and faster recovery times, you might be better off sticking with broader ETFs, like the S&P 500 or even total stock market funds like VTI. And don't forget, the Nasdaq 100 doesn't include small caps, mid caps, or non-tech sectors that often lead in different phases of the market cycle. A total stock market ETF gives you exposure to thousands of companies across all sectors and sizes. It's like owning a well-balanced meal versus just piling your plate with dessert. So, here's the key takeaway. The Nasdaq 100 is like a high-powered sports car. It's fast, exciting, and looks great when the road is clear. But when the weather turns stormy, when the market crashes, you might wish you were driving something with better traction. Diversification helps you weather the storm. It smooths out the bumps and gets you back to cruising speed faster after a crash. So before you go all in on the Nasdaq because of its past performance, ask yourself, are you ready for the downside when it inevitably comes? Let me know your thoughts in the comments below. Are you holding the Nasdaq 100? Do you mix it with other ETFs? Or are you leaning more toward diversified funds? I'd love to hear about your strategy and how you're managing risk in today's market. And if you found this video helpful, please give it a thumbs up, subscribe, and share it with someone who might be overexposed to tech without even realizing it. Thanks for watching, and I'll see you in the next one.